Welcome to this explainer. Look, today we are going to unpack a fascinating, yet honestly highly concerning financial dynamic that's unfolding right under our noses. We're going to talk about why everyday investors are feeling such a massive economic squeeze right now, and how the exact place you've always been told is the safest to park your money might actually be hiding a massive trap.
Okay, let's jump straight into this, because we've all heard the golden rule of modern personal finance, right? Invest in index funds, just set it and forget it. But we're uncovering this absolutely wild chain of events that literally connects your monthly grocery bill straight to the largest initial public offering, or IPO, in human history. To really grasp how your retirement portfolio might suddenly be exposed to new risks, we've got to connect a few crucial dots.
Section 1. The 2026 Financial Squeeze.
To understand the trap that's lying in wait within your passive index funds, we first have to establish exactly why you, and millions of other workers, are feeling so incredibly broke in 2026. Because it's this exact financial pressure that makes the trap work so perfectly. Let's look at your paycheck for a second. Average wages in the US have actually gone up by 18 to 20% since 2020. I mean, if you just look at that number in a vacuum, it sounds fantastic. Your paycheck grew. You might actually be making the highest salary of your life right now. But here's the reality check. Inflation over that exact same period has eaten up roughly 23 to 25% of your purchasing power. The sheer cost of just existing has completely outpaced any gains in your actual paycheck.
So the bottom line is that your raise wasn't really a raise at all. You're experiencing what economists call real wage decline. Think of it like having a pizza, right? Someone comes along, takes 3 slices, hands you back 2, and tries to tell you they gave you more pizza. That is exactly what the current economy has done to your wages. Sure, you have more dollars, but they buy significantly less than they did 5 years ago.
So where is all that money actually vanishing to? It's disappearing straight into non-discretionary categories, what we're calling the big 3 spikes. Rent is up 30% since 2022. Groceries are up 21%. And health insurance premiums? They just crossed a staggering $25,000 for the average family. These are fixed costs. You simply cannot budget your way out of this by, canceling a streaming service or skipping your morning coffee. This is a very real financial squeeze that is pushing everyday retail investors right to their limits.
Section 2. The supposed lifeline.
Now, with your living expenses climbing so rapidly and your real wages falling, traditional financial wisdom points everyone toward one assumed safe haven to rescue their future. The advice is basically, consistently put whatever money you happen to have left into a boring, passive, broad market index fund within your 401k. And hey, the logic is sound. It's low cost, it's highly diversified, and it completely shields you from having to play the game of picking individual winning stocks. But here's where we hit a really critical pivot. Have you ever wondered who actually decides what goes into those funds? Because the very mechanism that makes index funds so incredibly easy for you also makes them a guaranteed automatic buyer for whatever the financial system decides to add to the index. You don't get a vote in this. If an index adds a company, your 401k buys it automatically, no questions asked. And that is exactly where a massive shift is taking place right now.
Section 3. The SpaceX IPO Mirage.
So this massive macroeconomic squeeze we just talked about is about to collide head-on with Wall Street. SpaceX is currently preparing for an IPO at a staggering $1.75 trillion target valuation. Let's just put that into perspective for a second. That makes it worth more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. Just an astronomically huge number. But here's the thing you need to know. SpaceX isn't just rockets anymore. It's actually 3 entirely different businesses mashed together into one. Starlink, their telecom business, is an absolute crown jewel. It prints cash with incredible 63% profit margins. The rocket business, stable, pulling in about $4 billion. But recently, SpaceX acquired xAI. And this AI division is burning through roughly $1 billion a month. That cash burn dragged the overall consolidated company to a $5 billion net loss last year.
To really see the massive overvaluation risk embedded inside this company, we just need to look at xAI compared to its peers. OpenAI has an $850 billion valuation on $24 billion in revenue. Anthropic is at $400 billion on $30 billion in revenue. But xAI? It brings in roughly $1 billion in revenue, yet it was valued at $250 billion in the acquisition. It is being priced like an absolute giant in the industry despite bringing in a tiny fraction of the revenue.
And to really compound the risk for anyone who ends up holding this stock, the top talent has completely fled.
Literally, by March 2025, every single one of the 11 original co-founders had walked out the door. The company's leadership even publicly admitted that the asset basically needs to be rebuilt from the foundation up. So you have this cash-burning void sitting right at the center of a mega corporation.
Section 4. Rigging the rules.
Okay, so you're probably asking, who exactly is going to buy a company losing $5 billion a year at the largest valuation in human history? Well, you are, and here's exactly how Wall Street ensures it happens. NASDAQ literally just quietly erased the historical guardrails designed to protect their index. They call it the fast entry rule. Previously, a company needed 3 solid months of trading to discover its true price, plus a minimum of 10% of its shares available to the public. Now, they only need 15 days and there's absolutely no minimum float required. This means SpaceX can enter the index while only making 4 to 5% of its shares available. They have completely cleared the runway specifically for massive listings like this one.
But the truly crucial point here is this hidden multiplier. Under these new rules, a tiny 4% slice of available SpaceX stock will legally force ETFs and index funds to buy in as if it were 12%. It artificially manufactures massive, mandatory demand. And this directly impacts your retirement portfolio. The safety of your index fund is totally compromised because it is now forced to buy heavy weightings of stocks that simply haven't undergone proper market testing.
Section 5. The passive investing trap.
Let's dive into exactly how these institutional maneuvers land directly in your lap and why everyday retail investors are the ones left carrying the bag here. While a normal IPO typically offers maybe 5 to 10% of their shares to everyday retail investors, SpaceX is specifically targeting a massive 30% retail allocation. That is a historically unprecedented dump of shares straight onto the everyday public.
And listen to this recent quote from the SpaceX CFO, Brett Johnson, because it tells you exactly how the company views this unprecedented retail drop. They are ostensibly framing it as a reward for loyalty, saying retail buyers have been supportive of them and of Elon. But financial analysts are arguing that they are actually capitalizing on that exact loyalty to offload historically overvalued shares onto the public before the true market price can even settle.
This quote from portfolio manager George Noble absolutely hits the nail on the head regarding the risk to you. Your 401k is the exit liquidity. Ultimately, these shares are moving from the early insiders who bought in cheap directly into the passive funds of millions of everyday workers. The exact same workers we talked about in Section 1 who are just struggling to survive the 2026 economy and blindly trusting their 401k to do the right thing.
As we wrap up this explainer today, I really want to leave you to consider this very real risk to your personal retirement portfolio. Think about it. What does it actually mean for your future when the very mechanism you trust to build your wealth, your passive index funds, is legally re-engineered to bail out overvalued companies without your permission? It's a fundamental shift in how passive investing works, and honestly, just being aware of it is the absolutely crucial first step to truly protecting your financial future.